If you had to build a serious investment portfolio today, and you could only pick a handful of ETFs, which ones would actually give you the best chance at long-term wealth? Not hype, not TikTok stocks. I'm talking about real proven ETFs on the US stock market that investors are pouring billions into right now. And before we jump in, quickly, an ETF, or exchange-traded fund, is basically a bundle of stocks you can buy in one trade. Instead of picking individual companies, you're buying a whole group at once, which gives you instant diversification. Now, let's get into the best ones to look at right now. Quick disclaimer, this isn't financial advice, but these are some of the strongest ETFs in 2026 based on performance, diversification, and long-term potential. And by the end of this video, you'll know exactly which ones fit your strategy. First up, the backbone of almost every portfolio, the S&P 500 ETF. Think tickers like VOO, SPY, or IVV. These track the 500 biggest companies in the US, Apple, Microsoft, Nvidia, all in one. Historically, the S&P 500 has returned around 10% per year on average, and the fees are insanely low, which makes this one of the best long-term investments you can make. If you're only buying one ETF, this is probably it. Next, if you want even more diversification, look at a total US market ETF like VTI. Instead of just the top 500 companies, this covers basically the entire US stock market, thousands of companies. So you're getting exposure to small, mid and large caps all in one. This is what a lot of long-term investors call a set and forget ETF. Now let's talk growth. The Nasdaq 100 ETF QQQ is heavily focused on tech, AI, software, semiconductors, the sectors driving a lot of future growth. Because of that, it's historically outperformed the broader market during strong periods. It's a bit more volatile, but the upside is higher if tech keeps leading. If you're more interested in income instead of just growth, check out VYM, the Vanguard High Dividend Yield ETF. This focuses on companies that consistently pay dividends. Think banks, energy, and large established businesses. These tend to be more stable and can give you passive income along the way. Now, here's a mistake a lot of beginners make. They go all in on US stocks. Adding international exposure can actually reduce risk and sometimes even boost returns. ETFs like VXUS, VEA, or IXUS give you access to markets in Europe, Asia, and emerging economies, which means you're not relying on just one country to perform. And if you're worried about market crashes or volatility, there are defensive ETFs like USMV that focus on lower volatility stocks. These won't skyrocket as much in bull markets, but they can hold up better when things get rough, which makes them useful for balancing your portfolio. So how would you actually combine these? A simple structure could be something like 50% in an S&P 500 ETF like VOO, 20% in a total market ETF like VTI, 15% in QQQ for growth, 10% in international exposure like VXUS, and 5% in dividends or defensive ETFs. That gives you a solid mix of growth, stability, and diversification. The big picture is this: ETFs are exploding in popularity because they're low cost, diversified, easy to buy, and over time they outperform most individual investors trying to pick stocks. If you're trying to build wealth in your 20s, you don't need to overcomplicate it. You don't need to gamble, you just need a few solid ETFs and consistency.